All right. It's part 3. Profit, the dragon. How to find it and not get burned. Jacob Soul, in his book that we've been looking at through the course of these first few videos, says that the medieval Italian merchants did what nobody else could before, in that they invented and made a revolutionary leap into the calculation of profit. And in his comments on Ditini, he says that the system of accounting that the Italian merchants came up with had to be able to calculate at any moment each partner's and investors, or person with an ownership interest in the business, each partner or investor's equity share of the profits. So this video is going to be talking about profit. Now, why do I call it the dragon? Well, kind of like Moby Dick, Captain Ahab's pursuit, Beowulf's pursuit of Grendel, and even Sir George's pursuit of the dragon. Profit is a bit like that elusive creature that men seek to capture or conquer, whether for fame, fortune, or power. As you can tell, I'm a bit of a mythology guy. Okay, so we're going to kind of tell this story about profit in terms of its elusiveness and what men will do to try to capture it. Profit is not a bad thing. It's really not a bad thing at all. Businesses don't survive if they are not profitable. However, an unhealthy obsession with it, like Ahab had for Moby Dick, can lead to a dark place. So, we'll get back to this a little bit later, but we need to talk about what profit is and how we find it. So, our process of doing double entry accounting is no different than what we've looked at in the previous videos. We are going to be recording journal entries in the general journal, posting them into the general ledger, so that we can determine the status of each element by the end of the period. Our rules for debits and credits have not changed from what we learned in the previous video. Assets are increased with the debit, liabilities with the credit, stockholders' equity with the credit. And again, as long as debits equal credits, the equation stays in balance. Our broken down equation looks like this. Common stock and retained earnings are the two pieces of stockholders' equity. Common stock represents the amount the owners have invested in the business out of their own pockets. Retained earnings, or kept profits, is how much they've reinvested in the business from the profits of the enterprise. So here's going to be our main focus for this video. These 3 temporary accounts: revenue, expenses, and dividends. Now, we're going to generally be focusing on revenues and expenses in this video. Dividends we'll be talking about a little bit later. But revenue, again, is the amount charged to customers for products or services. Expenses are the costs that a company incurs in order to generate that revenue. So, paying your salaries for your workers or your wages for your workers, incurring advertising cost or utilities cost, incurring things like supplies expense, and such like that. And so we're going to be looking at how we calculate profit, and our primary focus is going to be on these temporary accounts. But what we haven't done yet is we haven't talked about what the rules are, debits and credit-wise, for these accounts. Now, the rules for these accounts are the rules that they are because of how they affect retained earnings. Retained earnings is increased with a credit because it is an equity account. And so revenues, expenses, and dividends have debit and credit rules based on their effect on retained earnings. And so revenue is something that will actually increase your earnings. The more revenue you have, the greater likelihood you're going to have greater profits or earnings. And so it increases retained earnings, and so it has a credit balance. Revenue is a credit account. Expenses and dividends, on the other hand, are both things that reduce the amount of earnings a company retains. Expenses reduce the amount of profits a company earns, and dividends then are payouts of the profits, which means that it reduces the amount of earnings that are retained or kept. And so expenses and dividends both are debit balance accounts. We record increases in those things with a debit. So if you look at the equation, assets on the left side of the equal sign are increased on the left side of the account, and liabilities and equity on the right side of the equal sign are increased on the right side of the account, with two exceptions, right? Two exceptions. Expenses and dividends are the two exceptions on the right side of our equation that do not follow that general premise. So, the temporary accounts are going to be our focus for this video. So we're going to run through a couple scenarios and see if we can determine whether or when revenue should be recorded. Revenue, again, is the amount charged to customers for products or services. So we have three scenarios here for our fictional company, Carl's Canoes. A customer pays $50 in April to reserve 2 canoes for a Friday evening in May. So should Carl record the revenue from this in April or in May? Well, we'll talk about that. Customers rent 4 canoes for $25 each on a Friday evening in April, and they enjoy a lovely time out on the lake. Third scenario, company reserves canoes for 10 employees on a Friday evening in late April. The employees enjoy the escape from cubicle life, and Carl sends a bill to the company for $250 on the last day of April. So, when do we record revenue for each of these three scenarios? In scenario 1, he's received cash. In scenario 2, he's received cash. In scenario 3, he hasn't received any cash. But is that when we should record revenue? Well, if you remember, when it comes to accounting, we have the elements, the things we are going to measure and report. And we also have principles and assumptions that tell us how to measure and report the elements. And so, the first thing we need to know is there a principle for this? And there is. Okay? The principle we're going to look at is called the revenue recognition principle. And it's essentially has 5 steps to it, but we're going to be looking generally at the basic premise here. And the basic premise is that revenue is to be recognized when it is earned. Revenue is earned when the seller of goods or services has fulfilled its performance obligation or obligations to the customer. So when Carl has done what he is supposed to do for the customer, then he has earned the revenue and he can record it in his journal. So let's look at the first scenario. Customer pays $50 in April to reserve 2 canoes for a Friday evening in May. Has Carl done what he's supposed to do for the customer yet? And the answer is no. Carl will not do what he is supposed to do for the customer until he allows those customers or customer to go out on the canoes on that Friday evening in May. So in April, he has not earned any revenue. Second scenario, the customers rent 4 canoes for $25 each on a Friday evening in April, and they go out on the lake and have a good time. Well, has Carl done what he's supposed to do for the customer? And he has, absolutely. The customers have taken the canoes out on the lake. Carl has fulfilled his performance obligation to the customer, and then he can record that in his journal. The third scenario, company reserves canoes for 10 employees on a Friday evening in late April. Employees enjoy the escape from cubicle life, and Carl sends a bill to the company for $250 on the last day of April. Has Carl done what he is supposed to have done for the customer? Has he fulfilled his performance obligation to this customer? And he has in April, right? These employees went out on the lake in April using Carl's canoes. He has earned this revenue, even though he hasn't got any money for it yet. He hasn't got any cash for it yet. So he fulfilled his performance obligation in April, which means the revenue from this needs to be in April. Okay? He's most likely not going to get paid until May, right, the next month. But that doesn't really matter because the revenue recognition principle says revenue is to be recognized when it is earned. Let's talk about expenses. Expenses are the costs incurred to generate revenue. So, on April 29th, Carl receives the April utility bill for $83. The bill is going to be paid in May. On April 29th, Carl pays in advance for May and June rent. $500 total. $250 a month. Third scenario, Carl pays an electrician $200 on April 17th for work done during April to fix faulty lighting in the store. When should Carl record expenses for these costs? Some of them he's paid for. Okay. Some of them he hasn't. But should cash payment be the indicator for when we have an expense? And the answer is no. Again, we need to know what the principle is on how to measure and report expenses. And so we have a principle called the expense recognition principle. Expenses are to be recognized when they are incurred. Expenses are incurred when the service being purchased has been received. So expenses must be recorded in the period in which they help the company generate revenue. As a result, this principle is often referred to as the matching principle. Expenses incurred in April must be matched to the revenues they help generate in the month of April. So expenses and revenues have to be matched together. Now, on April 29th, Carl received the April utility bill, $83. The bill is going to be paid in May. Should Carl record utilities expense here for this $83 in April, or wait until May? When did Carl use the utilities that gave rise to this $83 bill? Well, he used those utilities in April. And so he actually incurred this cost in April, even though he's not going to pay it until May. So he should record utilities expense in April. On April 29th, Carl paid in advance for May and June rent, $500. Should Carl record rent expense for this $500? The answer is no. Carl is going to incur the cost for May rent when he occupies the storefront in the month of May. He's going to incur the cost for June rent when he occupies the storefront in the month of June. Since he is paid in advance for these costs, okay, he does not expense them. May rent expense should be matched to May revenues. June rent expense should be matched to June revenues. So he's not going to record an expense for this. We'll look at what he will record in a minute. Third, Carl pays an electrician $200 on April 17th for work done during April to fix faulty lighting in the store. Does he have an expense for this or not? Should he record repairs and maintenance expense for this cost? And the answer is yes. Carl has paid the electrician during April. Does that mean he should record the expense? Is that the indicator? No, it's not. When did the electrician do the work? When did the electrician fix the faulty lighting in the store? And that was during April. And so the expense for this needs to be recorded in April, regardless of whether Carl actually is going to pay the cost. So both of these principles, okay, the revenue recognition principle and the expense recognition principle, are very important because they allow us to adhere to what's called the periodicity assumption. In order to effectively evaluate the results of a company's operations or its financial position, investors and creditors are lenders, people who have lent money to the company, or the company owes money to. Investors and creditors need information on a timely basis. Therefore, companies report results periodically. This is sometimes also referred to as the time period assumption. So we take the long life of a company, the annual period. Okay, here we're looking at a calendar year, January to December, and we're going to divide it up into smaller chunks of time. Now, we could require companies to report monthly results, but that's kind of overkill and a little bit difficult to do in today's day and age. And so what's required of public corporations is that they provide financial statements on a quarterly basis. So, quarterly basis means every 3 months of the year. So the first quarter, if we're looking at a calendar year, would be January, February, and March. Second quarter, April, May, and June. Third quarter, July, August, and September. And fourth quarter, October, November, and December. Now, the thing that might be different for companies is that they may not have an accounting year that is a calendar year that starts in January and ends in December. A company's accounting year, or what we call the fiscal year, does not have to follow the calendar year. Companies break their fiscal year into 4 quarters for reporting purposes, regardless of when it starts. So, we could have a couple different scenarios. We could have a fiscal year that begins in January and ends in December. Okay? That's a calendar year, fiscal year are the same thing. You could have a fiscal year that begins July 1st and ends June 30th. A lot of nonprofit organizations have fiscal years like that in schools. You could have a fiscal year that starts in March and ends then at the end of February. Some retail businesses do it this way because of Christmas and the holidays at the end of the calendar year. So your fiscal year doesn't have to follow the calendar year. Many companies it does, but not everybody. So it's important to understand the distinction. Now, here again, the rules for debits and credits. We're going to be looking at some actual transactions in a second, and we need to make sure that these rules have been solidified in our brains and make sure that we know what to do when something goes up or something goes down. How does double entry accounting actually work? Again, there's a 2-step process. The first step is to record business transactions in the journal. You first have to determine what elements are affected. Did they go up or down? And then do I debit or credit that account, that element? Fourth, we record the transactions in the journal. Again, we call these journal entries. Second step, once we've recorded everything in the journal, we are going to then post or transfer the information over into the general ledger so that we can have a summary of what happened to the account during the time period and we know where it stands at the end. So we're going to take a few minutes here and do some journal entries. Well, that was unexpected. Alright, computer fun, huh? Okay, so April 2027 transactions here, A through F. We're going to see if we can record these in a journal. Our journals are very basic again. They have a column for the date, which again most of the time we don't have dates, so we're going to use the letters. They have a column for our accounts, and then they have a debit and a credit column. So, transaction A, customer pays $50 in April to reserve 2 canoes for a Friday evening in May. What accounts are affected? Well, the customer gave Carl cash, so cash is certainly affected. What is happening to cash? Cash is going up. How do we show an increase in cash, which is an asset? We debit. So we're going to debit cash for $50. Now, we know that we're going to have a credit here, right? Because again, every transaction affects 2 accounts. Debits and credits have to equal. And so we are going to have a credit here for $50. What account are we going to use? Carl has not earned revenue here because he has not yet fulfilled his performance obligation. And so he owes something to this customer. Anytime a company owes an amount to a customer, By definition, that is called a liability. And so Carl does not owe money to the customer here. He owes services. He owes his actual business service. And so we are going to record this as an increase in a liability account, and we increase liabilities with a credit. And our account is going to be an account we call unearned revenue. Okay? Now that's kind of funny because unearned revenue, right, looks like a revenue account, but it's actually a liability account. So I'm going to put an L there, okay, just to remind us. Letter B. Customers rent 4 canoes for $25 each on a Friday evening in April, and they enjoy a lovely time out on the lake. So Carl receives cash. So increase in cash. We're going to debit cash. 4 canoes, $25 a piece, so $100 he has received in cash. Has he earned revenue here? And the answer is yes. He has earned revenue. Excuse me. Okay. He has earned revenue. Okay. The performance obligation that he has for these customers has been fulfilled. He has allowed them to use the canoes out on the lake, and so he has earned revenue. How do we show an increase in revenue? Revenue is a credit account. Why is it a credit account? Because it increases retained earnings, which is equity, and equity is increased with a credit. So we're going to credit service revenue, $100. Okay, letter C. Customers rent 4. Sorry, that's letter B. Customer C. Letter C. Company reserves canoes for 10 employees on a Friday evening in late April. The employees enjoy escape from cubicle life. Carl sends a bill to the company for $250 on the last day of April. So, what do? Carl has not received any money. Has he earned revenue? Yes, he has. He allowed them to use the canoes. They went out. They had fun. He fulfilled his performance obligation to the customer. So we have an increase in service revenue here. And again, we credit revenue to show an increase of $250. Now we know if we credit something for $250, we're going to have to debit something for $250, right? Did his cash go up? No, it didn't. Carl sent a bill. He has not received any cash. He has customers who owe him money. And anytime we have customers who owe a company money, we have what is called accounts receivable. Accounts receivable is an asset, and to show increases in assets, we debit, right? So, A, B, and C. Letter D. On April 29th, Carl receives the April utility bill for $83. The bill is going to be paid in May. So Carl has incurred an expense here, as we talked about before. He used the utilities in April that gave rise to a cost of $83. He's not going to pay it until later, but his utility expense has to be recorded in April. And so how do we show increases in expenses? Well, again, expenses and dividends are the two right side equation accounts that have debit balances. And so we're going to record here utilities expense of $83. Now, he has not paid this, so we do not have cash here. He owes this money to the utility company. And anytime we owe money to another person or a company, we have a liability. Liabilities are increased with a credit. And our liability account that we're going to use here is accounts payable, which represents amounts owed for goods or services that have been purchased. Letter E. On April 29th, Carl pays in advance for May and June rent, $500. Carl has paid cash, and so our cash has gone down. How do we show a decrease in cash? Well, we got to credit cash for $500. Now, if we credit cash for $500, we need a debit for $500. What are we going to debit? We're not going to debit rent expense here because, again, these 2 months have not yet happened. And May rent expense needs to be recorded in May. and June rent expense needs to be recorded in June. And so, since we have paid in advance, we have prepaid for rent, we use an asset account that is called prepaid rent. So what we're going to have to do with that later, we'll look at in other videos. Okay. Letter F. Carl pays an electrician $200 on April 17th for work done during April to fix faulty lighting in the store. So Carl needs to record here an expense because the electrician fixed the faulty lighting during the month of April. Carl did pay for it, but that's not really what dictates when an expense is supposed to be recorded, as we notice here in letter D, right? Utilities expense was recorded, but cash has not been paid. So Carl has incurred this cost in April. We are going to record an increase in an expense account called repairs and maintenance expense of $200. He has paid the money, so our cash has gone down, and we credit cash as it's an asset to show a decrease. So these are the journal entries that Carl would record for the month of April. Now let's take a look at the overall effect of this. So here's the journal entries. Okay, again, we have cash and unearned revenue, cash and service revenue, accounts receivable and service revenue, utilities expense and accounts payable, prepaid rent and cash, and repairs expense and cash. Now, once we post these transactions into the general ledger, we have updated account balances as shown by these T accounts here on the right. We have $650 left in cash. We have earned $350 in revenue. We have $250 in accounts receivable, and so on. So our overall general ledger looks like this. Okay. Now, as we go forward from here, we have updated account balances at the end of the period. We can build financial statements from this. So our financial statements then from these T accounts, okay, will look like this. We have income statement for the month ended April 30th, 2027. Revenues of $350. Expenses of $283, the repairs and maintenance expense, utilities expense. And so we have net income or profit, right, of $67. So our profit figure for this month of April is $67. The retained earnings, then as of April 1st, we had none. We didn't have any earnings from before yet. And so our net income of $67, less the dividends, which we didn't have any, leaves us with retained earnings of $67. So we go to our balance sheet and we look at these permanent accounts, right? Cash, $650. Accounts receivable is a new one that we have on the balance sheet for this company now, $250. Supplies, $150 still. Prepaid rent, $500. And so we have total current assets, $1,550. Equipment at $300, and total assets of $1,850. Liabilities, we have $233 in accounts payable, unearned revenue of $50, notes payable of $500, so we have $783 in current liabilities. Again, remember, unearned revenue is a liability account. It is not a revenue account, so it's here, right, on our balance sheet. We don't have any long-term liabilities, so we can simply leave it with total current liabilities there. Under stockholders' equity, we have common stock of $1,000 and retained earnings of $67, so $1,067. And as a result, we have $1,850 in total. Now, balance sheet again always has to balance. That's why it's called a balance sheet. And these are our financial statements for Carl's Canoes for the month ended April 30th of 2027. Now, one of the ways that we analyze these statements, like we showed in the previous video with the current ratio on the balance sheet, is we have a ratio here we call net profit margin. And we calculate net profit margin by taking net income and dividing it by total revenue. And so here we take $67 and divide it by $350. 67 is net income and 350 is total revenue, and we get 19.1%. Well, what does this mean? It means that for every dollar that the company earned in revenue, 19.1% of that dollar, or 19 cents roughly, was profit. So here, every dollar the company earned in revenue, 19 cents of it got down to net income. Was this good or bad? Well, that's kind of a tricky question. It kind of depends. It depends on what the expectation was for the company. It depends on what the company had in profit margin in the previous periods, or what it was last year at this time. And so we have to compare these ratios to other things, whether it's our previous performance, our expectations, or our competitors, to really say if it's good or bad. Now, I want to go back to our discussion of profit. Now, profit is something that is sought by corporations and by business leaders. But to give a little context to where I'm going here, I want to look at a passage from a book that was written in 1932 called The Modern Corporation and Private Property by Adolph A. Burley and Gardner C. Means. In this book, they say it seems almost essential that if the corporate system is to survive, that the control of great corporations should develop into a purely neutral technocracy, balancing a variety of claims by various groups in the community and assigning each a portion of the income stream on the basis of public policy rather than private equity. In 2017, many years later, in his book The Golden Passport, Duff McDonald said this: "Modern corporate society is broken. Shareholder capitalism wasn't the answer. It led to the exploitation of many for the obscene enrichment of the few. Business has lost its sight of its true function in society, which is to provide a mechanism by which we can work together and with our environment to achieve our common goals. It is not, and never has been, simply to make a profit." Now, in looking at these two quotes, they really hit at what is the purpose of a corporate? What is the purpose of a business? And so, when I look at this, and when we as business people should look at businesses, we need to think about a few things. So we're going to look at some questions here in a minute, but before we do that, I want to talk about an owner's responsibility. A business owner who starts a business, maybe it's out of his garage or out of his home, or maybe it's not, maybe it's bigger than that, but they have some responsibilities, right? They have responsibilities to employees. They have responsibilities to their community. They have responsibilities to the government, to the lenders they borrow money from, to the suppliers they buy stuff from, to the customers they sell stuff to. So, an owner should consider responsibility to all stakeholders. Stakeholders are, again, anybody who has an interest in the business enterprise. And so, what happens in our modern corporate society, the way our economy works right now, at least for public corporations, we start to have some problems with this. So, profit is merely one of the company's concerns, right? It really should be merely one of the owner's concerns related to his business. We have to have profit. Profit, again, is not bad. Profit is good. But when we have a situation like we do today with modern public corporations, we run into a bit of a challenge here. Okay? Today, a public corporation is owned by its stockholders, right? And some corporations have, millions of shares of stock that are out there in the world. And so these owners, these stockholders, can't run the company. They don't make the decisions really about what the company should be doing or anything like that. They hire, through a board, a chief executive officer. And this chief executive officer is the person who runs the company. It's not the owners, really, that run the company. The chief executive officer is the one that is in charge of the daily functions of the enterprise. Now, his or her primary responsibility is to the stockholders. And many stockholders, unfortunately, only care about making money. They're only concerned with owning the stock is making money. And so even though the chief executive officer has responsibilities to all of these other groups, okay, if the company is focused primarily or only on the profits and earning as much profit as possible so that it can please the stockholders, then we have a profit problem here. Okay? This is where the dragon comes out. If we are pursuing this elusive thing called profit as our most important objective, or the only objective, then that's going to lead to decisions that have a negative impact on a lot of these other interested stakeholder groups. So, here's my point. So what? In The Golden Passport, MacDonald argues that business schools have failed to create an empirically, philosophically, and morally defensible understanding of how we act and how we should act when we engage in business. And so, what does that mean for us? Well, I think that means that we need to ask ourselves some questions as business people, as we enter the business world. What purpose or purposes do businesses serve? If we're going into business careers and desiring to be business people, what is it that the business has as a purpose? What is its role in our community and society? How should businesses behave? What things should businesses do and should they not do? Now, we could be talking here about a legal thing, right? What's legal for businesses or what's illegal for businesses to do? But I think it's more than that. I think we need a deeper discussion of what should businesses do, ethically speaking, right? Now, what's ethical and what's legal are not always the same thing. How could the current business world be improved? What could be done, or what should be done, to make business better in the United States and across the globe? Is our current system working the way it should? Okay. Is the current way we have organized business in the United States or in the world working the way that is most beneficial to most people? And what will your mission be as a business person? Right? If you're going to be a business person, what is it that you, right, as an individual, believe businesses should do and should be about? Now, again, I don't pretend to pose these questions thinking that I have answers for you that are specific for you. These are just questions that I think we each, as individuals who go into business, need to be able to answer for ourselves, okay, in our endeavors. So, let's summarize a little bit. The calculation of profit was invented by the Italians as a way to determine the change in equity interest of investors. Profit is one of the main factors that explains the change in a stockholder's equity. Today, the Financial Accounting Standards Board, or the FASB, right, says revenue, the amounts charged to customers for products or services, should be recognized when it is earned. This is the revenue recognition principle. Expenses, the costs incurred to generate revenue, should be recognized when they are incurred, and this is the expense recognition principle. These two principles are extremely important as we desire to abide by the periodicity or time period assumption. So we have two principles and an assumption in this video. Number 3, profit can be dangerous if it is the only or primary interest of those managing or owning a company. And remember,